everybody, it's Kevin and Pat from NorthStarBadCharts.com, and we've put out some charts just recently, some big picture macro charts on our Twitter feeds, following a little bit of a discussion me and Pat had yesterday. Kind of got our brains working overtime, and for the benefit of everybody, we thought we'd just have an open discussion about it, put it on YouTube, and let you all just listen into our thought processes. So this is a lot of the stuff that goes on in the background with the chart production on our website for our members, and this is big picture macro stuff. Of course, we deal in much more detail on the website with individual stocks and shares and a whole range of different investment vehicles, investment types, commodities and cryptos and all sorts on there, uranium and goodness knows what. But we're going to focus on the three charts that I've put out in the last 24 hours, and I think Pat's put out 3 as well, and we'll just see where the discussion takes us, really. So yeah, so the first chart I started with was this one, and really I started with a blank sheet and just put on the 10-year Treasury yield, the 10-year yield, and I started building the chart from that point, and it was really to identify evidence. We talk about weight of evidence quite a lot on the website and on Twitter, and if you just look at any one thing in isolation, when you're trying to make a prediction about the future, you can very quickly come to an incorrect conclusion, because one piece of evidence can be pointing in one direction whilst a whole load of other evidence is pointing in the other direction, and that weight of evidence that's pointing in the other direction is telling you that that other scenario is far more likely. Obviously, if you've only got one piece of evidence supporting your idea, then it's pretty weak. So yeah, so what I've done here, I've drawn a support line on the 10-year yield and then a resistance line. What it shows is that in the 1970s and up to 1980, there was a particular trend in place, a particular paradigm, if you like. There was a particular macro environment that existed during that time frame, and that changed. Well, it actually changed after we peaked here in 1980. Gold price peaked and the 10-year yield peaked, and that was the culmination of that whole inflationary period of the 1970s. From a technical chart point of view, you can identify the point at which, from a technical perspective, we entered a new paradigm, we entered a new era, and it's when it crossed this support line, crossed a threshold, and then for the following 35 years or so, we were in very much a disinflationary environment, where increasingly with time, inflation rates came down as a general trend, and the 10-year yield reduced as a general trend. There were little upticks along the way, little periods where the 10-year yield and inflation picked up a little bit, but it was, the whole lot was contained by this resistance line, pushing it down and down and down and down and down until now, until right now. This is a quarterly chart, so this is the quarterly candle that we're in now, which is April, May and June. So we need to wait till the end of June to get a candle confirmation on this quarterly chart. But you can see quite clearly we've got a breakout here, and it suggests that we could be at the start of a new paradigm. That's one piece of evidence, and so I started to look at other pieces of evidence. So I put on the 10-year real yield. The real yield takes into account inflation, and inflation is the green line. So you've got the real yield in blue and the inflation rate in green. So what can you identify in the 1970s that might point to what could be happening at the moment? Well, what happened with inflation, of course, it went up very, very rapidly in 2 very distinct waves. The first wave during the earlier part of the 1970s, and the second wave after a bit of a reset came in the late 1970s, and at the same time as inflation rocketing during those 2 periods, the real yield plummeted in sync with that. Of course, that makes sense, because whatever the yield is, if inflation is taking off at a very high rate, then the real yield, when you take inflation into account, is going to be falling. And fast forward to, well, after 1980, that situation sorted itself out, and as I say, went into a very, I suppose you could think of it as quite a calm and controlled period, generally speaking, compared to what's happening now. What's happening now is that the inflation rate has just flown out of the gates and is breaking to levels that we haven't seen looking back across the chart here on the green line since the 1980s, in fact. So inflation is taking off in a very, very big way. Transitory, it isn't. And at the same time, the 10-year yield is reacting to that, of course, because the 10-year real yield is reacting to that because the yield itself is only rising relatively slowly whilst the rate of inflation is taking off like a rocket ship. So the real yield is dumping. And that explains to a large extent, or to a considerable extent, why gold hasn't fallen significantly. And in fact, it's just recently retested its all-time highs. And something else I put on this chart is the correlation coefficient. And this is what's called the Spearmint rank correlation coefficient. You need to worry about that. What it basically shows is how two instruments are correlated with each other. And I've set it up on this particular chart so that it shows the correlation between the 10-year yield and the 10-year real yield. So when the bars are red or purple and below the zero line, it means there's a negative correlation. It means that they're moving in opposite directions. And when the bars are green and above the zero line, or blue or green and above the zero line, it means that the correlation is positive. So they're both moving in the same direction. It could be up or it could be down, but they're moving in the same direction. Whereas when it's below the line, they're moving in opposite directions. So something that very quickly draws your attention is that during those two events in the 1970s, inflationary events, the correlation coefficient was deeply negative. And you can see that reflected in the chart above. The yield and the real yield are moving in very much opposite directions. And it gives a guide as to, I suppose, just how extreme conditions are. I mean, it's very obvious visually that you can see the yield and the real yield are going opposite directions, and that makes absolute perfect sense. You'd expect them to, but the extent to which that's happening is what's important. Is the speed and the violence of the move that is significant, and that's shown by just how low these red bars go. And I've marked a dotted line on here which shows where it usually stops, where history shows that the negative correlation tends to reverse. When it doesn't reverse at that level, something else quite big is going on, as history has proven in the 1970s. And this is the first time in 40 years, over 40 years, that we've had a red bar below that dotted line. And if history is a guide, then we can get another, bearing in mind these are quarterly bars, we could certainly get another 3, 4, or even 5 of these bars that are below the line. So many, many months, or even up to a year or so, of these conditions persisting and inflation running away with itself. And underneath at the bottom, I've got the gold chart, and I've indicated in general terms, these aren't exact numbers, there's just a general indication of how much gold went up. It doubled during the first inflationary period in the 70s, and then went up 600% during that second period as a ballpark figure. And we had a good couple of good periods in sort of in that run up between 2001 and 2011, in an environment that was generally far less favourable for gold to go up. So this what we think of as a good bull run in gold was actually taking place in an environment that is less favourable than clearly it was in the 1970s, and more importantly, less favourable than we have now, because the conditions we have now are pretty much a mirror image of what we saw in the 1970s. So it was a chart to really show all of the weight of evidence from those different factors, and why, in particular, as analysts and investors, we need to not compare what's happening now to what's happened in the previous 40 years. We need to start comparing what's happening now to what happened in the 1970s. There are more parallels with that period in time.
Yeah.
What do you think, Pat?
Yeah, this one, I think it merited all that verbal commentary on it, because it's so rich. Me, honestly, when you showed me that chart, what stuck out to me was the correlation coefficient. So between the real yields and the yields. So that means there's so much inflation that the real yields, it's really negative. And you're right. What happened in 2001 to 2011, there's a lot of clues that was just an inflationary cycle within a disinflationary secular cycle, right?
Yeah.
And that was crazy, the move it brought up nominally in gold. But now, man, look at that correlation there. It's definitely, we're way past 2001, 2011 type of moves. We're going back into a full secular inflationary cycle, especially if we close above that paradigm shift on the 10 years.
Yeah.
We have to start looking at, and I started that counting the bars like you did. So there's at least, let's say there's 3-4 more bars. That's at least like 9 months, a year before we hit probably a first peak in inflation rate, right?
Yeah, and
Until
this ties in with, I think, the fact that we've got an 8-year cycle low in gold, which is due sometime around about 2024. If I've got my calculations right, it's probably going to be in the later stages of 2024. So we could well see this double surge of this event, where the first phase of it, like the early part of the 1970s, gives way to some, bit of a relief period as we pull back into 2024, and then it all goes really crazy during the second part of this decade. That's the roadmap anyway. So moving on from that to my second chart, which is this one here. This one's perhaps a little bit simpler in a way, and it's really just the chart for gold price with the 3-year moving average on there. And this is a look at what I've identified as box number 1 and box number 2. If you draw the gold chart in this particular way, the arc, which I've shown on many of my gold charts, can be shown as a tilted arc as well. If you do it this way, it helps you to highlight these two kind of box areas. And many people have said to me over the last sort of year or so, well, maybe not a year, but several months anyway, that there's a lot, very striking similarity with what happened in the period 2011 to 2013. And, we're going to break down and we're going to see gold somewhere between $1,000 and $1,500. So that's fine. Visually, I agree. There is a strong similarity there. And as it happens, the actual size of the box in terms of time is exactly the same at the moment. There's no particular reason why it has to make a decision right now, up or down. The box doesn't have to be exactly the same size. It's just a bit of a coincidence that it is at the moment, and it could well extend. Box number 2 could extend to the right a little bit further. But I do think that decision is coming soon. And if we dig a little bit deeper, and instead of just looking at the price chart, we actually look at some technical indicators, we can build some evidence to tell us whether what happened in 2013 when price broke down, whether that is being repeated now. So the stock RSI is a useful one. It's a very helpful indicator, I find, along with many of the others, but I've focused on the stock RSI here at the moment. And what happened in this period, 2011 to 2013, apart from the fact that we've just seen a very big run up in gold from $250 to a couple of $1,000, so hundreds of percent, which we haven't just seen now. So that's one difference straight away, is that we're arriving in box number 2 and we haven't made the sort of gains that we have when we arrived in box number 1. And also in box number 1, we were, well, okay, I'll go back to stock RSI, which I was about to talk about. In box number 1, the stock RSI had been very high and was falling throughout box number 1, and it hit the low zone, or the dead zone as I've called it, and it bobbled around in the dead zone in box number 1, and it was down in that dead zone when the price of gold broke down and fell hundreds and hundreds of dollars, as we now know, into late 2015. So the stock RSI was low and it fallen from a high point. So is that what's happening now? Well, no, because the stock RSI, instead of being high and falling into a low zone, is low and rising into the high zone. So instead of falling from the power zone into the dead zone, we're actually going from the dead zone into the power zone. So it's the exact opposite. So it's the 180-degree opposite of what happened in 2013. So why would you expect what happened in 2013 to the price of gold to happen now based on the stock RSI? Simple answer is you wouldn't. You'd expect the opposite to happen. Okay, so that's one piece of evidence. Another piece of evidence is the 7-year rate of change indicator. And what was happening with the 7-year rate of change. So the idea of the 7-year rate of change, if you set the rate of change at 7 or 8 years, it picks out the 7 to 8 year or 7.5 to 8 year kind of cycles that we have in precious metals. And it seems to work particularly well with either 84 or 96 months. So we've got it set on the 84 here. 96 would show the same sort of thing. But the rate of change had been rising and rising and rising throughout gold's bull market, and it had reached a high level. And during box number 1, it leveled off and it began to fall as box number 1 built out. And as you can see, it was falling down towards the 0 line at the point where the gold price broke support and fell hundreds of dollars. So is that what's happening now? Is the rate of change high and falling? Well, no, the rate of change is low and rising. So instead of falling towards the 0 line, it's actually been below the 0 line and it's now rising back up above it. So it's the 180-degree opposite of what happened in box number 1. So this supports the data we're getting from the stock RSI in telling us that box number 2 is going to resolve itself in the complete opposite direction to the way box number 1 did. Rest my case for gold's defense.
And guys, just notice in 2012, remember that peak we talked about, Kevin, there in the box number 1, the peak before it went down? Yeah, there, that you'll see that the stock RSI was in the dead zone when we had that dead cat bounce, right? But look now, when we're going up, we're not having that bounce in the dead cat zone anymore. We're having it. We're more than 50% above. If Kevin would have drawn a line at the 50 mark on the stock RSI, we're above it now already, right?
Yeah,
so
yeah. And good things happen above the 50 level. If you look at the bull markets in gold, the stock RSI can make brief dips down below the 50, but generally speaking, the stock RSI spends much longer in those high zones and dips briefly into the low zones, and then the opposite happens during a bear market. So the onset of a bear market, you can see the stock RSI barely even made it into the high zone before it fell all the way back down again to here. So it spent all of this time below the 50 level, whilst the price of gold fell all the way down here and it hit the bottom of the arc. After hitting the bottom of the arc, you can see that the stock RSI spent much more of its time up here in the higher levels. And interestingly, stock RSI has reset all the way to the bottom here, and it's spent a reasonable amount of time down here. But has gold collapsed? Has the gold price collapsed and come all the way back down to 1050 or 1100 or even 1200, $1,300? It hasn't. It's held all the way up here, making only very brief visits to the area above 1650. And that's telling us something as well.
It is. There's so much fear, Kevin. My troll count has quadrupled in the past week. That means something, we're close to hitting a bottom.
Yeah, it's there's still a lot of disbelief out there. And here's another chart just to finish off my little contribution here, where I've tried to line up a lot of the indicating factors that show us what gold is likely to do going forwards, and how what's happening now has echoes from the past. So I've written on here that the US dollar index doesn't itself directly impact the gold price. It's interesting to follow it, and it no doubt has a psychological effect on traders and investors. But crucially, the US dollar index itself has far less to do with the dollar value of gold than you might think, because what you really need to take into account is what inflation is doing to your fiat currency of choice. Doesn't matter whether it's US dollars or whether you're looking at euros or Japanese yen or British pounds, the country that you're in. If you're looking at how you value the price of gold in your paper currency, well, what's going to affect that? What's going to affect that is how your paper currency is losing its value against everything around us, not just gold, but silver and platinum and wheat and sugar and oil and all of the commodities, and ultimately everything that goes into making everything that we buy and eat and purchase and use. Cotton for making clothes, for example, the cooking oil for making our food produce, all that kind of stuff. So what I've got lined up here is inflation is the next one down, and you can see again how inflation was pretty subdued after the 1970s, but with some notable upticks in inflation, particularly 2001 to 2008 and 2009 to 2011, which precious metals investors will recognize as periods when gold and silver did particularly well, even though we're in a broader disinflationary environment. There's also a little bit of an uptick in inflation back here in the late 1980s and into the early 1990s. And at that point, gold had a move, I think, of around about 60% as well. So there's a little bit of a small sort of bull run, I suppose you could say, in gold at that particular period. Underneath, I've got the US dollar index adjusted for inflation. That's the third panel down here. And this is, should be a bit of an eye-opener for a lot of people, really, because it's just going from the top left to the bottom right of the chart. I suppose you could argue that the dollar index itself is doing that to some extent, but really the level that we're at now of 100, we were actually at back in the 1980s. If you look at the chart here, whereas the inflation adjusted dollar index, we're at a lower level than we've ever been. In fact, the dollar index adjusted for inflation, if you look at the numbers there, is 0.39. Well, it started in the 1970s at a value of more than 2. So it's gone from 2 to 0.39. So what's that? It's lost how many times? 0.39 going to 2, about 6 times, 5 or 6 times. So it's lost over 80% of its value, probably 90% of its value during that period. Whereas the dollar index itself, the DXY, is at the same level that it was sort of 40 odd years ago. So a very, very big difference there. And that explains why, or explains to some extent, why you need to consider very carefully what you're expecting gold to do at any given point in time. Don't just look at the dollar index and say, well, the dollar index is rising, so that means gold is going to struggle. Well, not if the dollar index adjusted for inflation is going down strongly at the time. And also, if you combine that with an inflationary uptick, and by the way, this isn't just an inflationary uptick like we've seen during this 40-year period, this is an inflationary tsunami like we saw during the 1970s. So you can see very clearly and visually that inflation is taking off at a steep angle of ascent, just as it did in the first wave in the 1970s. And also at that time, the dollar index for adjusted for inflation was falling, as it is now. And then another element which is really important here is the PPI, the Producer Price Index. It's another reflection of inflationary pressures, I suppose. But during this 1970s period, the PPI rose 140%. Now, over the 40 years or so that followed, the PPI only rose about 111%, it shows on there. So in that short period there, 8 or 9 years, it rose more than it did in the following 4 decades. So PPI rising at a steeper rate of ascent has got something to do with all of this. Particularly, take note of the fact that when gold had its nice run from 2001 to 2011, it coincided with the PPI rising at a steeper angle of ascent. The majority of this gain in PPI of 111% actually happened in that period 2001 to 2011. In fact, it broke out of the measured zone here. It ended up lower down, which is where I've used my measuring tool, but it actually broke out above that level. So it's just highlights that the majority of that rise in PPI was during that period when gold went up a lot. And you can see the gold chart on the bottom here. It went up from about $250 to a couple of $1,000. And now compare that to what's happening now. So the PPI angle of ascent is much steeper than at any point in its history, including the 1970s. So the PPI is rising more steeply. The dollar index adjusted for inflation is falling. Inflation is rising at a steep angle of ascent. So all of those factors put together mean that the dollar index going up in nominal terms is nothing but a tiny ripple that's being overwhelmed by a tsunami of macro events that are starting to take hold. So this is another piece of evidence, and I'm trying to be objective here. I'm not trying to prove my point or prove my case. I'm trying to objectively look at this chart and read what it's saying. All of these elements I'm looking at in a scientific fashion to find the correlations and what happened when these sets of circumstances happened in the past. And with a completely unbiased mind and unbiased view, you can only look at this and conclude that what's happening now is very, very eerily similar to what happened in the 1970s. So why would you expect the outcome for gold, silver, eventually platinum and commodities generally to be any different? In fact, we've already seen what's happened with a lot of commodities. Again, I kind of rest my case for the defence for gold, and conclude that the expectation is, regardless of any short-term down moves that may occur, if we get some kind of market sell-off, the big picture outcome is going to be incredibly bullish for precious metals.
Yeah. Well, that's, for me, that's a big takeaway there. The DXY is like the mystical boogeyman that everybody looks at. But step one, the DXY is practically the Euro USD. Honestly, we've overlaid them. So essentially, when you're talking about DXY, you're talking about the fiat currency pair of how's the US dollar doing versus the euro, right? And then we've looked at other currency pairs that track more, like the miners, let's say the USD CAD or the USD odd, the Australian dollar. They track a lot more the precious metals sector than the DXY could. And yeah, so there's a lot of elements. So for me, the takeaway is, as long as PPI keeps going up, then it's there's pricing in to do for purchasing power that's being eroded there by that increasing price. And yeah, great stuff, Kevin.
Okay, we've got some charts, Pat, to continue the story, I think.
Yeah, let's continue the story, guys. I'll try to scare you. Share screen. Share screen, share. All right, there we go, guys. Okay, so okay, let's start. Okay, I'm going to reverse engineer this. So I was looking at the NASDAQ chart. Here is the NASDAQ's percentage of stocks above the 200-day moving average. So this is like the breadth indicator. People like to see if there's barely any stocks above the 200-day moving average, then there's no more stocks that can keep going down. Hence, eventually, these are places where the indexes could bounce up, right? It's almost like an oscillator. So where we are today, look, this thing has been rolling over, and we spotted this a long time ago. There's a line here, broke down. But Jesus, look at that, the quantity of stocks for the NASDAQ above their 200-day moving average, man. It's at a 28%. It bounced on the 21% line. There's not much. Whereas here's the 200-week moving average for the NASDAQ. And we've seen that important bounces have happened on this line. And if it doesn't hold, then we're in this area here where the type of GFC crisis. So, all right, I take a step back. Then I want to see how silver performs or another asset. So I overlay it. And I try to identify every time that this indicator has bounced, the percentage of stocks for the NASDAQ above their 200 moving average bottoms. What did silver do after? Right here, it was when this started crescendoing upwards, silver started moving up already ahead of the NASDAQ. When the NASDAQ kept rolling over and did a double bottom, silver started going up. Second clue right here, if we could count this one, there was another bounce in silver. So when the NASDAQ's percentage of stocks bottomed out and it started moving up, and right here it was hitting its 200-week moving average. What did silver do? It did a melt up. So either a crash, a melt up, or a top. So here, the situation here where the NASDAQ bounces close to its 200-week moving average, the percentage of stocks bounce up, but then after that, as the NASDAQ recuperates, it's end of the bull market for ERA. For silver, after parabolic melt up, decides to go in bear mode, and we know the story how that goes. Here's another occasion where it happened. The NASDAQ starts rolling over, percentage of stocks hits that 21% line, 20%, NASDAQ recuperates. But what happens also to silver? We have that nice bull run, that wake up bull run we had from early February 2016 all the way to mid 2016. Next time this happened, NASDAQ starts rolling over. That's the December 18th. I think that was a reboot market crash or the Powell pivot, whatever you want to call it. NASDAQ bounces up. What does silver do? That the bottom's put behind and it starts going upwards. March Madness, another severe out of the blue expected crash. Just bam, went down. Fed steps in. The NASDAQ started bouncing up. And silver outperformed the NASDAQ out of the gates. So every time silver, or 5 times out of 6, that silver, when the NASDAQ was really weak, whatever they did to save the NASDAQ, silver out of the gates blew out and outperformed the NASDAQ. So this is the question. That's where we put in all the charts that Kevin put out. What type of situation are we here right now? So I put out a poll on Twitter. Are we in a situation where silver at this stage here decides to do a melt up like 2010, or do we have a crash and then we melt up? Guys, until silver closes above that 2750, then these scenarios, there's a lot possible. But the takeaway for me is something will happen right here where we are. We're gonna have one of these situations that's gonna play out very, very soon, guys. And
yeah, I think it's a high risk period at the moment for stocks, for the markets generally. That's reflected in other charts like that 10-year yield, for example, which is in a very precarious place at the moment, mathematically speaking. It's difficult to square a circle that involves yields rising beyond that line that I have got marked on the charts that I put out. So, for various other charts that we've looked at do suggest a lot of caution here. There's some type of event, nasty event could unfold here that that causes problems across the markets generally, including precious metals. The precious metals wouldn't necessarily be, certainly wouldn't be immune from a broader market sell-off. It's just that all of the charts are pointing to the fact that, medium to long term, precious metals are incredibly bullish. So, it's a time of risk here, and the charts need to be followed very, very carefully to try and, as Patrick was saying there, decipher whether we have a breakdown here, some kind of meltdown here, or whether, as I sort of suspected for many years now, that would happen probably in about 12 to 18 months' time. We shall see. Yeah,
well, maybe in 2024 it's going to be worse. Maybe look at that. The NASDAQ has the 200-week moving average is about at 10,600. So I'm just wondering right now if this thing, the bounce was weak. Maybe not like a GFC type level, but maybe it will do a flash crash over a week or 2, 3 weeks. Maybe that's why the silver and gold have been weak recently. They're kind of bracing for this type of flush out. But guys, that's when you can't have the fear. You have to understand where you are in the cycle at the beginning, or are you at the end, and then get ready for the bounce back up. Because
the long-term charts do say pretty clearly not to be afraid. The short-term charts say, well, yeah, okay, you could end up needing to change your underwear if that does happen, because everybody would be really sort of panicky about it. But if you have that confidence from the longer-term charts, you would realize, a bit like March of 2020, that it's an incredible opportunity.
Yeah, they're all here. Look, the silver moves, the greatest silver moves have happened when the NASDAQ was struggling on the onset. As the precious metals are going to sniff out, they're going to recuperate just before silver, before the NASDAQ, while the NASDAQ people, they capitulate for a week, 2, a month late more. These are the opportunities right here, guys. So we're getting close to an opportunity. It's just a question, do we suck it in one more time and or we bounce here? But we're close to I think we're closing in on a resolution for that. Here is another setup. So I was trying
I looked at this chart for quite a while. I do like this one, Pat.
Look, it's A, B, C, D, E. I was
looking for E for quite a while. I was like, A, B, C, D, A, B, C, D. Where's the E? And then I saw it.
Well, I just try to be coherent in putting the level. So here you could tell me if I'm wrong. So A, top, bubble market top, A top. B, the echo bubble. Here, see, there's a small bubble here. I didn't mark it. I marked this bubble here, an important bounce up, and then a failure, breaks down. Here, I didn't mark it as C because it didn't do a new, it didn't start doing a new higher high or higher like after base. And here, see, going back above the 3-year moving average. Now it does a new peak. Oh, now it does a new peak here. I marked it as C, like the wake up. Go back, drown. And D, this is where it's important. D is higher than C. D is higher than C. So for me, this is higher. This is definitely a higher high. And this is D was the first time in all this bull cycle that we had a higher high for silver. So that was my step one. Situational analysis stretched above the 3-year moving average, super bullish, right? Inclining 3-year moving average, stretched above the 3-year moving average. And also here, the distance from the 3-year moving average, guys, after D, there's consolidation towards the 3-year moving average, consolidation towards the 3-year moving average. That's the E. So I'm pretty sure this as a analog move or fractal, but on a shorter time span, this has a lot of the same clues that I've seen in this whole big pattern. We're seeing them again. I know we're close. This could be, this line could be totally false, Kevin, because if we're in the 70s, this angle of ascent will be completely different, right? It might be totally sharper, but I'm just, if let's say we're going to follow 2001 to 2013 type of run up.
That's a sort of a conservative estimate, I would say. You know, that's if things progress in a pretty controlled manner.
Yeah, we could have these type of moves, guys. Move up, then we're below pivot line. Pivot lines love getting retested, overshoot, re-challenge from the top, then fail. This is totally, this is just a copy paste of this zone here. It could be shorter, it could be higher, but the goal is, are we in a bullish construct? And that's why here it's important, guys. I outlined critical that we stay above that 3-year moving average right here. If we do
the
like
3-year moving average shouldn't be broken except on the 8-year cycle low.
Yeah, or some type of GFC event. So that's why I'm on the fence. I have a low probability that we're having a GFC for the NASDAQ. If I go back to the first chart where the NASDAQ stayed a long time under that 20% of stocks above the 200 moving average, I'm putting, it's a possibility, but maybe 10, 20%. I'm favoring maybe more now. The NASDAQ gets saved, maybe a flash crash in NASDAQ, the Fed jumps in or whatever reason, and maybe a spike all the way down to the 3-year, which is at 2150. Even on the smaller timeframes, could maybe spike below, but close above on the monthly close basis. And then we finally make a move up. But that's the maybe 60, 70% that, maybe 20%, 25%, maybe a crash. But end of bull era, maybe 5% at this stage, Kevin. Honestly, I seriously doubt that we're going to a 5-6 year bear market for silver. It just doesn't make sense in the total weight of evidence.
The evidence isn't supporting that at the moment.
But like this, yeah, the stock RSI chart you showed and all the other ones, this is not a top here. So if we crash below, it'll be more like a GFC type event where we get saved. But I seriously doubt that that we've done a blow off top for silver. It loves doing blow off tops. Like
the distance from SMA there, you know, when we broke down in 2011, 2012, it had been at a very high point and it was descending steeply towards zero. Well, now it's been below zero and it's clawing its way back above. It's doing the opposite of what happened when it broke down. So
yeah, exactly.
It's the opposite. It's the opposite picture. Higher lows on that distance from moving average. That's what you want because it pulls the moving average up.
So short term, I know I could put for finish. I'll put an interactive chart for silver on the shorter term. Short term, daily, like a lot of the trend lines broke down, stuff like that. But you got if you do a situational analysis, even here, let's say in the 2011, 2013 top, it was starting to break down on the daily. It was stretched above moving averages. Like the whole thing was stretched. While now, even if we have weakness on the daily chart, it may be slightly on the weekly. It's still above the 30-week moving average, actually. Okay, I'll do this chart right after, guys. We'll have to do it. I'll do an interactive silver chart. So that one was, okay, let me go back to home, get profile. And I think this was the last one, Kevin.
Yep.
So because of the brainstorms I did with Kevin, the key is the producer price index. That thing is opening the gateways for everything. What do I have here? I have monthly chart. I have the producer price index, and look at silver. Silver, guys, people, it's below its 1980 high, it's below its 2011 high. Look, silver, that's in its DNA. It's not staying. It didn't stay at 50 a long time. I did a chart where I showed the 12 or 16-year moving average. It's beautiful. It keeps going up. So look at that. Whenever you see silver above that PPI slowly going up, these are the opportunities where we make tons of money and there's forever missing out. But you can't count this as and judge silver by the peak it did there. If you would have put a nice moving average or inclining trend line,
just imagine a middle line through that silver chart. It's going from bottom left to top right. So the moving average of silver over any reasonable time period is going up and up and up and up and up. The spikes are very exciting and they're great, but you could view them as false, really. They're kind of noise in the overall trend and direction. Timing, when to sell your silver and when to buy your silver obviously is affected by those spikes, but the general trend over time is clearly from bottom left to top right, which is not surprising because we're measuring it in US dollars, and what's happening to US dollars, we've already spoken about that. And
that's why people ask, so you got to take that into account. The trick is you use TA to buy silver as close as you can to before one of these explosive moves, because that's what we want to do as chart traders. We want to make money off these explosion moves, right?
You can triple, quadruple your money, and then you know that it's a blow off peak. You quickly get out and then put those gains into something that is then going to continue to appreciate. Silver's so spiky and so volatile that it's not for medium-term investing. You can either do it very short-term and catch those big moves, or you can do it very long-term and hold your silver coins or however you invest in silver over decades. But there are probably better places to put your investments in silver over those time frames.
If you buy silver at the lows when nobody wants it, you could hold them forever. Silver is about buying it at the correct moment. It's not buying it at 50 or when it's in melt up mode. Don't touch it. You have to buy it. If you would have bought silver when it was below the PPI there, you buy here, anytime here, you're great. Here at the low, below the PPI, fine. Here, close to the PPI, that was probably the last chance to get in. Buy in anytime here during the whole 1980s. You're buying cheap. You're buying at
buying cheap, but your problem there is the time that you have to wait. So it's that's a difficulty there. I mean, as Pat says, anywhere in that zone, the same theory applies. You're buying cheap, but you're not seeing it appreciate until the next big run up comes.
Exactly. Well, like let's say for stackers, let's say somebody who does want to hold silver, please don't buy when it's buy here. If you ever want to stack or put money on the side and you want to buy silver, you do it here. Here's another spike, and look, the PPI, guys, is just rushing up. So silver, the PPI here, see, was rushing up off the 2008 lows. Eventually, silver likes to go and crash above. Look, the PPI is going up, so silver was below it as the PPI was moving up, and then it finally did the exuberance move. And just look at the stock RSI. Here's the 8-year custom stock RSI, and do TA on it. So whenever we cross this line here, the warm-up zone, that's when silver, okay, something's happening. And then when you cross above this higher line here, then that's when you have long-term appreciation gains. They're not in a straight line, of course, guys, there's pullbacks, but here you have better chances of having gains than losses. Here, all this silver was stagnating, stock RSI stagnating, bull zone, good things happen. Even if there's huge pullbacks, silver did go from, I don't know, less than $2 all the way to 50 in the zone here. Bear zone, look, the stock RSI refused to go above the bull power zone or the power zone above this line. And that when it did above for that 2001 run, it did to 2008, did great. And even if the stock RSI went back down, just that move up to the warm-up zone created huge gains. And that was a warning sign, actually, because stock RSI refused to go back even in the warm-up zone, lower highs, even there's high lows on price action. That was huge bearish divergence. I say, oh boy, look, I went up, but without the same type of power to bring me back up. So that was another huge warning sign right here when you couldn't.
A lot of this, of course, is down to the fact that the silver market is a tiny market. So, you know, investor sentiment and froth, whatever you want to call it, can carry silver, as it did there, you know, 2009 to 2011, a ridiculous amount up in an upwards direction, whilst the stock RSI is actually not really, in a way, you know, telling you that that should be happening at that point. So, you know, stock RSI was rejected at that line, and that, as Pat says, that was a very clear warning sign, especially given the sort of parabolic rise up. So when it comes, and believe me, it is coming, and silver will blow everybody out of the water. When it does come, don't get greedy. Remember what we're saying here. Silver is incredibly volatile, and it will have a parabolic run up, and then it'll fall like a rock. So just be prepared for that. All the while, of course, the moving averages are moving up. But if we were to go to $150, for example, and then we pulled all the way back down to $50, a lot of people are going to be really, really upset, you know, losing 66% of their investment if they're getting anywhere near the top, which of course some people do. So the thing to do is, you know, to not be greedy, to get in when the getting is good, and to get out and not worry. If you get in now at $30, for example, and you sell at 100 or 120, don't worry if it goes to 200. That's not, you know, that's not what you need to worry about. What you need to worry about is getting in too late and exiting with huge losses, or having to sit in that investment for a couple of decades before you even get back to where you started again. So, you know, it's all about the psychology of investment, and it's also all about understanding the technical chart analysis and using the price charts and the technical charts to guide your entries and exits.
Yeah, because there's no emotions in the charts, guys. It's not your best friend with big eyes saying I made a fortune and buying XXX, right? That's too late when that happened. The gains were already done. That's why he has the glitter in his eyes. It's because he made money. But right here, nobody's really made money. So people are just getting ready to make money. So this is it. And just notice, guys, whenever we cross from the bear zone to the power zone, there's a retest. There's always a retest. But it stays after the retest. There's always a second wave up before crumbling. See, there's a retest, and then there's another wave up before ending the bull era. Even this one here, retest, another wave up. So right now, it's even turning back up, the power there is. But we could expect that thing maybe in the 2024 low, Kevin, this stock RSI is probably going to drop all the way down here and retest that line. If that line holds, then that's bullish evidence to buy. Whenever that stock RSI, the next time it touches this, you buy if the whole other weight of evidence, you know, is still intact, that'd be the second best buying opportunity.
Oh, and you've heard us mention this 2024 8-year cycle low we've heard me talking about it for years now, and that roadmap hasn't changed. I mean, there's no 100% guarantee that the 8-year cycle low is going to do exactly what it's done every 8 years since the 1970s. But then equally, there's no reason to expect that it's not going to do that. And there's no evidence to suggest it isn't going to do that. So that remains the roadmap until evidence shows otherwise. So that's our working model, if you like, is that expectation of a significant low point at some point in 2024.
All right, guys, to close it up, here is the weekly. So this is a smaller time frame, and I've been dabbling with this one. I'm not quite. So this is the 84 week period, 84 period. So 80 times week, 84 week stock. But I'm going to put the stock RSI also. And look at silver is still above its 30 week moving average right here. So this.
But if you're wondering why that is significant, I mean, people often ask me, you know, all these moving averages that we use, the 200-day, the 10-week, the 30-week, you know, the 12 months, 36 month, why are they important? They all have different uses, and it depends on the time frame that you're looking at, whether it's a weekly chart or a monthly chart or a daily chart. But it just so happens that the 30-week moving average is one that traders and investors use to guide medium to longer term moves. So the remaining above a 30-week moving average during an uptrending move is key, and any close below that, weekly close below that, is a piece of evidence. Doesn't automatically mean that whatever it is you're looking at is going to plunge in value. It's just one piece of evidence that a close below the 30-week moving average is a sign of weakness.
Exactly. So I'm trying to find analog moves. So if we're here and we broke down, and we visibly broke down, see here's a 1, 2, 3, 3 points broke down, maybe a case that we retested here. So on the weekly chart, the stock, which is a little bit slower than stock RSI, is already showing that it's going down. But the longer term, just like here we had in 2001 on the takeoff where it's really rough, broke down, but eventually what it does, it settles into a bull power zone that slowly creeps up, right? So after that, there's a slightly less steep angle support line, 1, 2, 3, 4, which is very powerful. And when that breaks down, then you know it's over. So steep, not the end of the world, but eventually, I don't know where this is going to settle. Depends where we stopped on the weekly chart for that momentum. If we stop, but honestly, I would expect it to start slowing down maybe in a week or two. And then if we close back above this line, the wake up line, then this could be just one of these situations here where we bounce on the long term, starting to define the long term trend line. And then we start crescendoing upwards, staying in the bull zone, up and down, up and down.
Yeah,
So
and as Pat's often said, you know, you can be bearish on the short time frame, but bullish on the longer time frames. So when we're talking bullishly about gold and silver, overwhelmingly that's over a period of time that you would use as an investor. So you know, we're talking about the coming few years, but within that there will be periods where it's appropriate to be short-term bearish, or short-term cautious at the very least, where you can see, you know, significant pullbacks. But the overall suggestion would be, you know, buy, hold, and add on weakness. You know, that's the type of strategy that tends to work in this environment, because trying to second guess the drawdowns or go short in a bull market is making life hard for yourself. You know, if you're going to go short, you want to be doing that in a bear market. In a bull market, yes, you get significant drawdowns, but you know, if you're in a bigger time frame bull market, then you are taking higher risk if you're going short.
Yeah, exactly, because those tidal waves of macro, whatever, they could sweep in at any moment, right? The people that were waiting to buy or like whatever. If you're above an inclining 3-year moving average, you have to give the benefit of a doubt to the 3-year inclining moving average. And so smaller time frames, like the 50-day moving average, you see it gets whipped crisscross all over the place. If you would have been using just the 50-day moving average here, thinking, oh, bear market, I'm below the 50. Oh, bull market, I'm above the 50. You would have get whipsawed to death. But look at that, the eagle in the sky, he would have seen you're still above a 200-day moving average, and he would have been fine. And he would have probably maybe even here started got out, and with rightly so, or even here, saying, look, I'm going to stay on the sidelines because now it's the momentum has slowed down. There's opportunity cost. And I just want to wait until this settles, right? Because for 224 days from this point on, or somebody here at $25 for 336 days, there was no reason to stay in silver for all this time. Once you close here, you could have said, okay, I'm just going to wait, let it prove it to myself. We know there's a breakout line at 28. And you could have had your capital elsewhere. You know, you don't need to be attached.
You can actually set up the moving averages, completely get rid of the price, and just set up your moving averages, and you can get rid of all of that noise and just play the moving averages. It takes out the spikes, it takes out all of the emotion, it takes out the panic when it's going down and the euphoria when it's going up. You can just set up a chart of the moving averages for silver and the moving averages for gold on the bigger time frame charts. You might use something like the I don't know, you could use the 3-year and the 1 year, or 3 year, whichever moving averages give you the key crossover points. I've done this before on some of the gold and silver charts, and you just buy and sell on the moving average crossovers, as Patrick's doing there. You know, you can see that the bullish crossover there on silver occurred a few years ago, a couple of years ago, and there's no need to worry until or unless they cross to the downside again. Yes, by doing it that way, you miss out on you know, a chunk of the move. You miss out on the spike. But let's be honest, how many people do you know that catch the spikes anyway? You know, it's very, very hard to sell at the exact top and buy at the exact bottom, But if you just trade the moving averages over a longer time period, if you're making investments for your retirement, for example, then yeah, save yourself all the panic and just use the moving averages.
Yeah, and not here, like here it could have reduced noise, bullish cross of moving average, and also above, so I could have moved it here and above a horizontal breakout line, right?
Yeah.
Here, same thing here. Moving average, but above breakout line.
Don't forget, of course, that once you've ridden the move to the upside and you take your finances out of whatever it is that you're invested in, this is the silver chart, but it could be anything, then you move it directly into something else that is just breaking out in the way that silver just did. So you don't have to wait years and years and years for silver to decide it's going to start going up again. You recycle that into whatever is in the opportune position again. So you just can keep building and building and building, keeping yourself way ahead of inflation.
Man, that was I think we've done it all. We've covered all of TA, guys. It's done. There's nothing else to learn.
Don't need to post anything else for the next 20 years.
Yeah.
Well, up and
I'm happy we did that. Share with everybody, not just our members. They get this like daily, you know, they get to talk to us. We have those live Q&As. We have master classes every month.
I mean, if you're curious what goes on at the website, it's this kind of thing, but covering, all the different investment sectors. So all the commodities, everything from copper to uranium to lumber to oil to you name it, and all the individual stocks and shares within those sectors as well. So if you're mildly curious about what goes on, feel free to join us. There's no commitment joining the website. If you decide it's a load of rubbish, you can you can cancel and leave after 1 month. Yeah, we talk a lot of rubbish, don't we, Pat, sometimes?
Well, I think the advantage is just we're not isolated. Let's say you'd be doing this by yourself, and like I've noticed that I work, let's say I do my charts, you do your charts, and we talk on the weekends, like practically even like all the time we're talking. And then we, these ideas, either they crystallize or then we challenge each other. So there's that added value of being at North Star Bad Charts is the fact that you have two guys that are there, you know, when one's sleeping, the other guy's working. So
sleep? Yes. You're telling me you sleep?
Ah, man.
I'm sat here at the computer doing charts at 3 o'clock in the morning. So.
Yeah, man, all good stuff. So we'll keep an eye on that stuff for you guys. Silver, shorter time frame, medium, long term, still bullish. Gold, same thing. Inflation, man, I think we're on top of it, Kevin, for now.
I hope so. It's challenging stuff sometimes, but it's all good fun.
All right, guys.
Cheers, everybody. See you later. Bye for now.